Welcome to our deep dive into the world of investing. Today, we're starting at the very foundation with a man named Benjamin Graham. Born in London in 1894, Graham later immigrated to the United States with his family. He would go on to become a renowned economist and professional investor, often referred to as the father of value investing. His profound insights and writings have significantly influenced the world of investing. Graham's teachings emphasize the importance of thorough analysis, long-term strategies, and the conviction to resist market pressures. His most notable work, The Intelligent Investor, is often cited as the definitive text on value investing. In this book, Graham introduced concepts that have since become cornerstones of investment philosophy. So buckle up and prepare to delve into some of his most notable wisdoms. From understanding the market as a voting machine in the short run and a weighing machine in the long run, to distinguishing between investing and speculating, we'll explore how these ideas can guide us in the complex world of financial markets. Let's dive in. Benjamin Graham once said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." This profound statement encapsulates a fundamental truth about investing. In the short run, the stock market is swayed by the collective mood of investors. It's a popularity contest, a voting machine, where the stocks that are most in favor rise, and those out of favor fall. It's a volatile, unpredictable environment, influenced by a myriad of factors ranging from economic indicators to political events, and even the weather. However, this is not the whole picture. The market's short-term behavior is just one side of the coin. In the long run, the market transforms into a weighing machine. Here, the substance carries more weight than style. It's where the true value of a company, its ability to generate profits over time, becomes apparent. This long-term perspective is where companies with solid fundamentals, strong management, and sustainable business models prove their worth. So what does this mean for you as an investor? It underscores the importance of patience and a long-term strategy. It's easy to get caught up in the frenzy of the voting machine, to chase after the latest hot stock or sell off at the first sign of trouble. But this approach often leads to poor investment decisions. Instead, think of yourself as an owner of the business. You're not buying a stock, you're buying a piece of a company. Look at its financial health, the quality of its management, and its competitive position. Make your investment decisions based on these factors, and then be patient. Let the weighing machine do its work. Remember, the market's short-term fluctuations are noise. They're the votes being cast, the popularity contest in action. But in the end, it's the weight that matters. The true value of a company will eventually be recognized by the market. So, it's not about the immediate popularity of an investment, but its true worth in the long run. Graham also advised, the individual investor should act consistently as an investor, and not as a speculator. Let's unravel this nugget of wisdom. The distinction between an investor and a speculator is crucial in Graham's philosophy. An investor in this context is someone who approaches the market with a long-term strategy. This person takes the time to thoroughly research and analyze each potential investment. They make decisions based on the intrinsic value of a company, its financial health, and its potential for growth over time. On the other hand, a speculator is someone who enters the market seeking quick profits. They are often swayed by market trends and rumors, buying and selling based on the hope of short-term price fluctuations. They are in essence betting on the market, which can be both risky and unpredictable. Now, it's important to understand that Graham isn't saying speculation is inherently bad. What he's emphasizing is the need for consistency. If you choose to be an investor, then act like one. Stick to your strategy, do your homework, and make decisions based on sound analysis. Chasing the latest hot stock or jumping on a trend because it's popular can lead to hasty decisions and potential losses. Investing is not a get-rich-quick scheme. It's a methodical process that requires patience, discipline, and a clear understanding of one's financial goals. It's about building wealth over time, not overnight. Consistency in your approach to investing also helps in weathering market volatility. By focusing on the long-term value of your investments, you're less likely to be swayed by short-term market movements. You're investing in the future of a company, not its current popularity. Graham's advice reminds us that investing is more than just buying low and selling high. It's a commitment to a strategy, a commitment to making informed and thoughtful decisions. It's about being patient and allowing your investments to grow and mature over time. So, let's take to heart Graham's wisdom. Let's choose to be investors, not speculators. Let's commit to a strategy, do our research, and make decisions based on analysis, not hype or fear. Choosing to be an investor means committing to a strategy, not chasing quick wins. Graham noted, "To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks." Let's unpack that a bit. When Graham talks about satisfactory results, he means returns that keep pace with the market or slightly better. This is not as hard to achieve as you might think. A well-diversified portfolio, patience, and the discipline not to panic when the market inevitably has its ups and downs can get you there. What about superior results? That's where things get tricky. We're talking about returns that consistently beat the market by a significant margin. Now that's a tall order. It requires a deep understanding of the market, a keen eye for undervalued assets, and an iron stomach to weather the market's volatility. The key word here is consistently. Anyone can get lucky with a hot stock tip or a risky bet that pays off. But doing it again and again, year after year, that's a whole different ballgame. So why is it so hard? Well, the market is complex, dynamic, and often irrational. Predicting its movements with any degree of certainty is quite frankly impossible. Even the most experienced investors and sophisticated algorithms get it wrong sometimes. Moreover, superior returns often come with superior risks. High-reward investments can just as easily turn into high-loss disasters. And if you're constantly chasing the next big thing, you might miss out on steady, reliable gains. This is not to discourage you from striving for exceptional returns, but it's important to set realistic expectations. Don't fall for the get-rich-quick schemes and promises of guaranteed success. They're more likely to drain your bank account than fill it. Instead, aim for steady, consistent growth. Invest in quality, not hype. Be patient and disciplined. And most importantly, keep learning. The more you understand about the market and your investments, the better your chances of success. Remember, good investing isn't about hitting home runs, it's about consistent singles and doubles. Graham made a clear distinction saying, "The most realistic distinction between the investor and the speculator is found in their attitude towards stock market movements." Now let's delve into this. At first glance, the investor and the speculator might seem pretty similar. They both participate in the stock market, they both invest in businesses, and they both aim to make a profit. But if you look a little closer, you'll realize that their attitudes towards market movements are poles apart. An investor is like a surfer patiently waiting for the perfect wave. They know that the ocean's tumultuous nature is not a threat, but rather an opportunity. The same way, investors see market movements as opportunities. They don't panic when prices fall sharply, instead, they see it as a chance to buy wisely. And when prices rise significantly, they don't get carried away by the euphoria, they see it as an opportunity to sell wisely. On the other hand, a speculator is more like a thrill seeker on a roller coaster, their heart pounding with every dip and turn. They view market movements as threats, not opportunities. They react impulsively to fluctuations, buying out of fear when prices rise and selling out of panic when prices fall. This reactionary approach often leads to hasty decisions based more on emotion than logic. So you see, the investor and the speculator are indeed different species in the financial ecosystem. The investor understands that the market is like a pendulum, forever swinging between unsustainable optimism and unjustified pessimism. And it's this understanding that allows them to remain composed, patient, and rational, even in the face of wild market swings. The speculator, meanwhile, is often swayed by the crowd's mood, buying into the optimism and selling into the pessimism, which can lead to poor investment decisions. In the end, it's not about who's right or wrong, but rather, whose approach better suits your financial goals, risk tolerance, and investment horizon. As an investor, market movements are your friend, not your enemy. Graham warned, the investor's chief problem and even his worst enemy is likely to be himself. This statement strikes at the heart of a fundamental truth in investing. It isn't the volatility of the stock market, nor the unpredictability of global events that pose the most significant threat to an investor's success. It's the person staring back at us in the mirror. We're talking about emotional investing, a phenomenon where decisions are driven by fear or greed rather than logic and analysis. It's when we buy high out of a fear of missing out, or sell low due to panic in a downturn. These behaviors are the bane of sound investing strategy, and they can wreak havoc on our financial future. Let's delve a bit deeper. We humans are creatures of habit, prone to cognitive biases that can cloud our judgment. Take confirmation bias, for instance. It's our tendency to only pay attention to information that confirms our pre-existing beliefs while ignoring the rest. In the world of investing, this could mean overlooking critical red flags about a company because we're so enamored with its potential. Then there's loss aversion, our inclination to fear losses more than we value gains. It's this bias that can lead us to sell off our investments at the first sign of trouble, even when the logical course of action might be to hold firm or even buy more. And let's not forget the bandwagon effect, where we follow the crowd into the latest hot stock or investment trend. This herd mentality often leads to inflated asset prices and ultimately, a market bubble. As investors, recognizing these biases is the first step towards combating them. It's important to develop a disciplined investment strategy, stick to it, and make decisions based on careful analysis, not emotions. To wrap it up, Graham's wisdom reminds us that the greatest challenge in investing isn't deciphering market trends or picking the right stock. It's mastering our own emotions and biases. When it comes to investing, sometimes the biggest obstacle to success is ourselves.